Okay, so you want to own a private jet charter company, buy a few jets, charter them out to executives and celebrities at premium rates, collect enormous fees for flying rich people around without the hassle of commercial security lines. It sounds like one of the most obviously profitable businesses money can buy into. Here's the strange part. One of the most recognized names in this exact business, backed by Delta Airlines, spent 13 straight years losing money before it ever posted a single quarterly profit. When that first profitable quarter finally arrived in the last 3 months of 2025, the company celebrated it as a genuine milestone. 3 months later, in the very next quarter, the company posted an $83 million net loss and watched its profit margin collapse from 19% back down to under 9%. 13 years to get to profitable. 3 months to lose it again. By the end of this video, you'll know how a charter flight actually gets priced, why an empty leg exists and what it reveals about the entire business, why one of the best-funded private aviation companies in the world nearly went a decade and a half without turning a profit, and why even a single good quarter in this business can evaporate almost as fast as it arrives. So, how does a charter company actually price a single flight? Not the way you'd assume. A charter flight isn't priced off distance the way a commercial ticket roughly is. It's priced off the cost of having a very specific, very expensive asset sitting in a very specific place, ready to move on a moment's notice. Average private jet bookings run somewhere around $17,000 to $18,000 per flight leg. Not per passenger, per leg, meaning one takeoff and one landing. A single New York to Los Angeles charter can run $25,000 to $35,000 round trip. That price isn't really covering fuel and a pilot's time. It's covering the fact that a 9-figure aircraft and the crew certified to fly it have to be available and ready essentially all the time, whether or not anyone actually books a flight that week. Here's the part that explains why this business behaves so differently from an airline. You're not actually selling flights. You're selling guaranteed access to an incredibly expensive, mostly idle asset, and idle time, not fuel or maintenance, is the real enemy of this entire business model. That single fact explains almost everything else about how this industry is built, starting with a term you've probably heard advertised without fully understanding: the empty leg. So, why do empty legs exist, and what do they actually reveal? When a jet flies a client from New York to Miami, it doesn't just sit in Miami waiting for the next paying passenger going the opposite direction. More often, it has to reposition, fly back toward its base or toward its next scheduled job, completely empty. That empty repositioning flight is a pure cost with zero revenue attached to it, unless the operator can sell a heavily discounted seat on it to someone flexible enough to fly on short notice in whatever direction the jet happens to already be going. This is precisely why charter operators obsess over a metric called utility, essentially the number of hours a single aircraft actually flies in a given period. One major operator's own disclosed data shows aircraft utility running somewhere in the high 40s to mid-50s hours per aircraft in a quarter, meaning even in a healthy operating period, a multi-million-dollar jet still spends the overwhelming majority of its time sitting still, not earning a dollar, while every fixed cost attached to it, crew salaries, insurance, hangar fees, scheduled maintenance, keeps accruing regardless. Now, here's the part that shows exactly how brutal that math becomes, even for a well-capitalized operator. Wheels Up was founded in 2013, went public in 2021 through a SPAC merger, and eventually became backed by an investment from Delta Airlines itself. About as much institutional credibility and capital access as a private aviation startup could hope for. And still, the company posted a net loss of $339.6 million in 2024 alone. Not a bad quarter. $250 million lost in a single year, on top of years of prior losses stretching back to the company's founding. It wasn't until the fourth quarter of 2025, 12 full years after the company was founded, that Wheels Up posted its first ever quarterly adjusted profit as a public company, $32.9 million in adjusted earnings, an adjusted contribution margin of 19%, and a net loss that had finally shrunk to $29 million instead of the $80+ million losses of prior quarters. The company got there partly through a familiar financial engineering trick from an entirely different industry, the sale-leaseback. In December 2025, Wheels Up sold 10 aircraft, 3 Challenger 300s and 7 Phenom 300s, to a leasing partner for $105 million, then leased those same planes back to keep flying them, using $65 million of that cash to pay down debt and banking the rest. Selling the physical asset out from under the business, then renting it back to fund the very operations the asset supports, the exact same mechanic that car wash chains and other capital-intensive businesses lean on when the underlying operating margin alone isn't generating enough cash on its own. So, did that first profitable quarter actually stick? No. In the first quarter of 2026, the very next reporting period, Wheels Up's adjusted contribution margin fell straight back down to 8.7%, roughly the same level as a year earlier, and the company posted a net loss of $83 million, nearly triple the loss from the quarter it had just celebrated as a turning point. Management attributed the reversal to transitory inefficiencies tied to modernizing its fleet, retiring older aircraft, and replacing them with a newer, more premium mix of planes, a transition that, by the company's own numbers, cost the business roughly 5 points of margin in a single quarter. Total gross bookings, the actual customer spending flowing through the business, were still up 10% year over year. Demand wasn't the problem. The cost of operating and transitioning an aircraft fleet was. So, what does this actually look like at different scales? A single aircraft charter operator lives entirely off utility. Their entire business is one asset, one crew, one set of fixed costs, and their profitability depends almost completely on how many hours that specific plane flies paying customers versus how many hours it sits on the ground or flies empty repositioning legs. There's no fleet-wide averaging to hide behind. A bad month with low utility hits that one operator's bottom line directly and immediately, with no larger portfolio of aircraft to offset it. A large, well-funded platform like Wheels Up operates on a completely different axis in theory. Dozens of aircraft, membership programs, corporate accounts, and a mix of owned, leased, and on-demand charter capacity that's supposed to smooth out the utility problem across a much bigger fleet. And yet, the numbers show that scale alone didn't solve the fundamental fragility of this business. It took over a decade, hundreds of millions of dollars in accumulated losses, backing from one of the largest airlines in the world, and a sale-leaseback deal on 10 aircraft just to produce a single profitable quarter, which then reversed within 3 months, the moment the company had to spend real money modernizing its own fleet. Bigger didn't mean safer. It meant the same fragile unit economics playing out across more airplanes at once. So, if you do decide to own a private jet charter company, understand what you're actually buying. You're not buying a service business that happens to use expensive equipment. You're buying an asset utilization problem wearing a luxury travel brand, a business where the actual product is keeping an extraordinarily expensive machine as close to constantly flying, paying customers as physically possible. In an industry where even the best-funded, most patient operator in the country needed 13 years and a sale-leaseback deal just to see one clean, profitable quarter, only to watch it disappear again before the next earnings call. The jets are real. The glamour is real. The margin sitting underneath both of them is thinner and far more fragile than anyone buying a ticket ever sees from their seat. It's Tuesday,